Hello and welcome to the Portfolio Matters podcast.
So Keith, what are we doing here?
Well, we are trying to communicate with private investors and people who would like to become private investors and to share our experience of managing our portfolios with a semi-sophisticated audience, I think I'd say.
Mm-hmm. And what do you think that we're able to provide them?
Honesty and a bit of investment nous without getting into the arcana and minutiae, and also we're British.
Yeah, absolutely. So I can, I think one of the things I find really helpful is listening to other people talking about the problems they have in investing.
Yeah.
Because when you're working on your own like that, it can be quite soul destroying if things aren't going right or you're not sure what to do.
I think that's absolutely right, Richard. And I think one of the problems about being a private investor is generally it's you alone with your computer and looking at the markets going up and down, and actually there are few other people in your particular position, and I suppose that's why we talk to each other quite a lot.
Absolutely. And typically what you see is the share that you own going down and everything else going up.
Yes.
Until you move to rectify that situation, when the share you did own starts to go up and the share you now own proceeds to go down.
So a regular feature of the podcast will be my worst trade. And so we aim to be entirely honest about our failings and successes.
With a little bit of competition to see who has the absolutely worst trade.
Yes, exactly.
So we feel we have an understanding of the practical difficulties faced by private investors.
Yeah. And also the reality is we've been doing this quite a long time.
Yeah. And we want to discuss relevant events in the world in a reasonably straightforward manner.
Exactly. So we're not going to go into the minutiae of the yield curve or options or futures or a lot of the other stuff you hear on other podcasts, which really we don't think are very interesting to private investors.
Absolutely. So we're going to tell you about our own individual investing styles to give you a little bit of background, and then we will explain what we want to try and cover each week.
Yes. Actually, before we do that, the other reason we're doing it is that I often talk to people who are not invested in the market and who have a little pot of money and are afraid of buying equities or moving their money out of cash. And as I tell them, and never really get much of a response to, the worst thing you could possibly do at the moment is be holding cash. And the next slide will show the power of compound interest.
Yes.
And if you leave your money in the bank, it is slowly dripping away through your hands. If you want to keep the value of that money, you really have to do something with it. And so the aim of this podcast is to give you a few ideas and to try and get you to take it out of the building society account where it probably is losing money steadily and do something more interesting with it.
Absolutely.
But before we continue, I'm afraid that we're going to have to read you that evil of modern life, the disclaimer. Take it away, Richard.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, Keith, what's this eighth wonder of the world?
So, there's an Albert Einstein quote: "Compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it." And on this table, you can see the effect of a low rate of interest, so cash, earning currently 0.1% in the bank. In fact, in my bank, First Direct, you don't even get that, you get zero.
Do you know, I remember many years ago buying a government bond that lasted 5 years and paid 10% per annum.
I think that ages us, Richard. I probably wouldn't mention that. Moving swiftly on. Go on.
I think they use it to build the sewers.
Actually, having said that, they've seen us. We can't get away with it anyway.
No, I'm only 29 really.
So, anyway, an active portfolio I think realistically you probably could get 5%. I mean, certainly, this year I'm up 30.
I think
a good year.
I think if you aim to get 5% and you're not overstressing yourself, you're not trying to do more than, you're not pushing the system so hard that you're going to trip up.
Absolutely.
That's the danger.
But so the aim of this table is to show that over 20 years, if you're earning 0.1% per annum, over the course of 20 years, really, that's not right, is it? Shit.
Compound to
That's not compounding, is it?
Must be.
Is it?
Well, it is, isn't it?
That's 20. I suppose there's not much much to compound.
There's very little, isn't there?
No, that is right, actually. No, I did do that. So, there you go. Over the course of 20 years, you make £2.
Whereas if you invest, we have inflation at 2% and an investment return of 3%, of 5%, you've got a net return of 3%, and that means over the course of 20 years you have a 78% increase.
Yeah, so basically, if you start off with £100 in the bank, after 20 years, at 0.1%, you have £102. After 20 years of an active portfolio of 5%, you have £265.
And at 5%, your risk is probably pretty low.
Well, we do our best, but
So now we thought we'd have a chat about our investment processes, and it was quite interesting. So we both went away and we independently wrote down what our investment process is and how we wanted to present it for the purposes of this podcast. And we found something interesting, haven't we, Keith?
Well, the thing is, when asked the question, I focus very much on the process by which I identified buying opportunities.
And I focused very much on the process by which I would manage the buying opportunity once it was identified. In other words, how I manage myself.
Yes, and I think that's very important. I mean, I also know this stuff, as you know how to identify an opportunity, but I think the difference in emphasis is quite interesting.
Absolutely, and I was saying to Keith earlier that it's like the Venn diagram of our thoughts that we've put down on paper is like that, but actually, in terms of how our understanding of what the process should be, the Venn diagram is like that.
Yes.
But we have emphasised the way we think about things has brought an emphasis out.
Right. So on that note, should we actually start talking about exactly how we do things? So, first question. How much time do you need to actively manage your portfolio?
Well, I spend about 2 hours a day, I think.
That is quite a lot, I'd say, Richard.
Yeah.
But if we're aiming for people to be able to do this yourselves, I mean, I think it depends on how much you need to do and how much you enjoy doing.
Yes. So I subscribe to a channel called Real Vision, and I listen to probably an hour or two of webcasts a day. I read the FT, and I listen to some other podcasts.
Right. Well, I read the FT in the morning. I check my regulatory news service feed about all my stocks. We'll go into at some stage exactly how you set that up with the London Stock Exchange. And then I look at the news and I listen to a few podcasts. But I would say that in order to do this seriously, you need to spend at least a couple of hours a week, I would say, which includes listening to this.
I would say that I find Real Vision very useful because it teaches me a lot of things about macroeconomics that I haven't known.
Right.
And so I am on a learning curve in that regard.
Okay.
A lot of it is very general and doesn't really... It gives an overview of how the world of economics and finance works.
Right. So, one day a month, I do my trading and trade accounting. Actually, that's not quite true. I mean, when I say one day a month, that's very much on average. Yeah. Some days, months, I will spend literally all day trading if I think there's a turn in the market, and 2020 has seen some of those. How about you?
Yeah, so as we'll come on to in a moment, my my investment strategy is a fairly long-term investment one, so I try to trade as little as often, as little as possible, as little as possible, and but like you, sometimes things happen and one needs to devote a bit more time and attention to it than other times. This year has been particularly intense, I would say.
And I should also say that we will be doing another podcast 2 in the series, which will be a review of 2020, when we will be going through an extraordinary year in the market and how we've both managed to navigate it fairly successfully.
So far, Keith, so far.
That's true.
The year is not yet over. So, do you want to tell us about your information sources, Keith?
Yes. So I largely use information sources that are free, and with the advent of the internet and Twitter, I think you can get an awful lot of very good information sources without paying anything for them.
So I find Twitter really difficult, but possibly because I don't follow the right people.
I think it is difficult. I think one of the frustrations is you can follow somebody who is quite sensible in their particular line of work, and then find that they twit 17 times a day about their dog, which is frustrating. We will be including on the website a list of the people we follow on Twitter who we think are useful.
Keith follows.
Yes, that's right.
Since I don't follow anyone, although perhaps I will be soon.
So I subscribe to the FT just as my daily newspaper. Is it really necessary to subscribe to the FT? No. Vast majority of it is just news. And actually, I think the market section is really not that useful at all. I don't think there's anything in the FT you can't get for free from various newsletters.
I think that's probably right. I'd probably spend 20 minutes or so looking through the FT in the morning, reading the headlines and dipping into some of the articles. It's more a scanning exercise to see what's going on in the world, I would say.
The one thing I would say that you absolutely need to do is you need to be aware of what's going on for the companies that you own. And the best way of doing that is to get a news feed which is free from the London Stock Exchange, so that every time there's a company announcement, you get an email.
So Keith, what information do you think people don't need to follow?
Well, I think you need to be aware that management can never tell you anything they haven't already declared to the whole investor base. So if you go to the AGM or you go to an investor conference and you see management speaking, be aware that they're not going to tell you anything new. And when I first started actively managing my portfolio, I went to a lot of AGMs, and in at least 2 cases, I came a cropper by listening to management.
And what? Can you give us an example?
So, one of the worst trades of last year was in a company called Hurricane Energy, in which I lost a lot of money. Now, this is a bad trade that developed over the course of a few years, but suffice it to say that one of the reasons that I failed to get out what I should was I went to the AGM for several years in a row. I spoke to management, I asked questions, I looked the CEO in the eye and got a straight answer. And the bottom line is, I believed him and I drank the Kool-Aid and I swallowed the story whole. And as the shares started to go bad, I failed to get out because I thought the market doesn't appreciate this story, which I understand, but they don't. So to go back to the beginning, Hurricane Energy is a small UK oil explorer which claimed to have found the largest oil field in the North Sea discovered since the 1970s. And most oil fields the oil is trapped in sandstone. So the oil is actually held in little pores in the rock. The thing about Hurricane Energy was it claimed to have discovered a massive fractured basement oil field. A fractured basement is where the oil is held in cracks in impermeable granite. So the oil isn't in the rock, it's in cracks between the rocks. Now, fractured basements have been known for a very long time, and they have been successfully exploited all around the world. However, they are notorious for it being very difficult to estimate how much oil is in the oil field. And the CEO of Hurricane Energy, Dr. Trice, was an expert in this field, and he estimated that this was a huge resource. But you can only really know how big the oil field is when you start producing it. And then you measure how much the pressure is dropping as you take barrels out. If the pressure doesn't drop at all, you know you have an enormous resource. If the pressure starts dropping quite rapidly, you know actually it's quite a small oil field. So I started investing at 15p, and it went up to its maximum of 60p, at which stage I was feeling quite proud of myself, having discovered this little gem, and I'd made a lot of money.
Very profitable investment.
It was. And then when it came to 2018 and I sold all my oil shares because I thought the cycle had peaked, I looked at Hurricane Energy and I thought, I don't want to sell this because I'm going to crystallise an enormous CGT bill. And at 60p, I think the shares are materially undervalued because actually they should be worth £1. So I thought, I will sit through the cycle and I'll just keep hold of these shares and wait for the next cycle when I know they're going to go to £1. So as oil came off, the Hurricane Energy share price came off as well. And then some disquieting news basically steadily came out of the company. There was, as they were producing the oil, there was water. Now, there shouldn't really be water, but they explained that away as being perched water, which is water that is trapped with the oil. And the share price kept on drifting off. So from 60p, it went quite rapidly down to 55, then 50, then 45, 30. And throughout this period, I held on thinking, well, the oil price is coming off and, you know, this is an enormous resource. At no stage, because I had seen the CEO, looked him in the eye, and he had given me this estimate of resource, I never questioned it. And so the share price continued to drift off, and I didn't do anything. I had no critical thinking about it whatsoever.
Did you tell me earlier that you actually at one point bought some more, Keith?
Well, this year, when the oil price cratered in March, I bought more. I bought more at 8p. So then, new management came in, they fired the CEO, and they issued a press release in which they basically cleaned out everything. And so they stated that the previous estimates of the resource had been massively overstated, that the reason for the water production was they had underestimated where the oil-water contact was. It was now much higher than they had previously stated. And they wrote down the size of the oil field by 95%. So the shares cratered to 3p, at which point the shares mainly became useful for their massive CGT losses.
So Keith, let me ask you this question though, which is, you obviously were you believed the resource was there and as stated.
Yeah.
But clearly the market didn't.
That's right. And the thing is,
now why
Richard, the key point
or
about...
what could you have done differently with the benefit of hindsight that might have given you a clue?
Well, I think that the prices, or generally, the market knows more than you do. But my point is, I wasn't listening to the market.
Yeah.
And if I had, in fact, I wasn't doing any critical thinking at all because I believed him.
Yes.
And if this had been any other oil company, I just would have sold it. But because I believed the story,
Yeah.
I didn't.
You suspended your critical thinking process.
Yeah. So, when I look back on this worst trade, lessons learned. Don't go to the AGM, it's pointless. Yeah, they will not tell you anything you don't know already, and they will put a positive spin on
And
everything.
indeed, it may be counterproductive because it affects the way you think about the company.
Precisely. 2, don't let tax considerations change your investment strategy. I should have just got out and paid the tax. I would be much better off now than leaving it drift off until it was at 3p. And finally, the biggest thing was I just stopped thinking because I believed him. I didn't actually critically look at this holding when it drifted from 60p to 3p.
Yeah.
So,
Well, Keith, I'm sure you're not the only person who's ever done that, but it is a salutary lesson. And one of the things I feel is that if you have the ability to hear people talking about these things that happen to them or talk to other people, they can give your thinking a nudge to knock you away from perhaps what is a fixed point of view that isn't receptive to new information.
absolutely.
And that can be really useful.
And I think one of the key points is that occasionally you just have to admit you're wrong. And the most successful investors are the one who are fastest admitting they're wrong.
Yes.
And in this case, it wasn't because I wasn't willing to admit I was wrong. It's that I just took the word of the CEO and I didn't even think about it. I didn't even think of the possibility I might be wrong because I stopped thinking.
So, Keith, that's really interesting, and I think sharing these stories with our viewers can provide them with an insight into other people's mistakes. And I'd like to share one of my worst trades in our first weekly podcast in 2021.
Fantastic, and I look forward to that, Richard, especially as it seems to be a piece of stock market archaeology.
Yes.
And on that note, we would love it if you would write in with your own worst trade so we can benefit from your experiences, and we can be found at info@portfoliomatters.co.uk, and we would love to have a phone call and talk over the lessons you have learned.
What instruments do you use? What do you invest in?
Well, I think we're both long-term investors.
Yes.
So I mainly invest in UK stocks, because I know you trade a lot of international stocks. I mean, what would you say the mix is, Richard, in your portfolio?
I say it depends, Keith. I'm very comfortable trading international stocks. The rationale for doing so is trying to find the best company in the sector in which I'm investing. And there are some sectors which the UK is not well represented in.
I'd agree with that.
No.
But what I would also say is that in the UK there are 1,000 stocks, and you can generally find a stock that represents the idea you're targeting. And the advantage of the UK is generally it's cheaper to trade. Now you may have a better source.
No, I would agree with you. If you trade outside the UK, you pay exchange rate conversion margins, and you also have an exchange risk, exchange rate risk.
Absolutely.
So I would agree with you, and I think on balance, if you can find a suitable company in the UK, it's better, safer, and cheaper to trade in the UK.
Great. So I also trade ETFs, which are exchange traded funds which hold a variety of stocks, where if I just want to buy, say I've had an idea where I want to buy uranium, I might buy a uranium ETF rather than...
I think ETFs work very well if you don't have a particular view on which company in a sector to buy, which companies in a sector to buy.
I would also say, Richard, that ETFs can work very well if at the bottom of the cycle they're at a big discount to NAV.
Yes.
Where suddenly there's a big panic, and I know we both bought the Van Eck Junior Gold Miners ETF
Yes.
when it was at a huge discount.
Yes.
because everyone just wanted to sell it.
Yeah, that was an extraordinary situation. I think also the danger of ETFs is that some of them have quite esoteric investment strategies and they're not really what they say on the tin. And unless you're an expert or go delving deep down into the details, you don't find that out, and you may be buying something that isn't actually representative of what you think you're buying.
I'd also say that we only trade plain vanilla ETFs. The 3 times leveraged ETFs, whatever, those are a disaster and should not be touched with a barge pole.
And in fact, I think you can trade something like a 3 times leveraged ETF where the underlying market might go up by 10% and your 3 times leveraged ETF doesn't go up at all because of the slippage, I think, in the way they manage their investments.
That's precisely, it depends on the volatility. Also trade bonds, the gilts, which have the advantage of being capital gains tax free, but as we will discuss throughout the year and in the review of the year, I think that gilts are currently very dangerous because they have limited upside and a large amount of downside with a change of inflation.
Absolutely. And then we both have some angel investments, don't we, Keith?
We do, which is how we met, and we will be talking through this in plaintive terms, no doubt, week on week.
Yeah.
Needless to say, we have had thus far no exits and a few write-downs.
But hope springs eternal.
Absolutely.
And one day we may have some success in that way.
One day we may just get round to actually paying the tax rather than trying to avoid a 30% tax rate or whatever it is by investing, a lot more in dodgy small companies. But anyway.
And just to reiterate, we don't trade in futures, options, or spread betting or structured products. Not because we have anything against them, but because they're complicated. I don't fully understand them, and I don't feel I have sufficient knowledge to be able to trade those successfully.
I will hold my hand up and say I used to do some spread betting, and when we come to my worst ever trade, so spread betting is very dangerous, and actually I was short selling, which was even more dangerous, and I lost a lot of money. And actually since then I have done a couple of spread bets in very specific circumstances, and which were successful, but I did not enjoy the experience, and frankly it's something you don't really need to do, and I would wholly recommend you don't touch.
So I suggest you should say that, Keith, because I have also done a bit of spread betting in the past, and I don't do it now. And for me, the problem with spread betting is it encourages you to trade frequently, and my psychological profile for trading is that I'm a long-term trader, and you get a huge conflict between those two things.
I completely agree with you, and I think that's why I didn't enjoy it, is that actually seeing the P&L minute by minute changes your psychology and changes the amount of stress there is involved in the trade. In that if you have £10,000 worth of BP and it goes down 1%, you don't really care. But if it goes down, you see you're losing £100, £1,000, and it's changing all the time. Suddenly it becomes, when you see a loss like that, it becomes a live thing.
Oh, absolutely. Your £10,000 of BP cost you £2,500.
Yeah.
Any loss is effectively percentage terms amplified by 4, and typically you won't be able to stomach that large loss. And rather than holding the share for 2 or 3 years or whatever you should be holding it, you'll sell it after 3 days.
Absolutely.
Keith, why don't you tell us about your investment strategy and priorities?
Well, I think as a private investor, your number one priority has to be avoid losing money.
Yep.
So that means not taking too much risk. And frankly, my approach, as you will see as we go through this, is that I take quite a lot of risk, but I look at it every day and I try and be nimble on my feet. So when I think things are going against me, then I try and get out very quickly and cut winners and losers, everything, and go back to cash. So actually, when you look at the end where I present my performance of my SIP over the last 10 years, you will see that sometimes I haven't got this quite right. And one of the things that I struggle with is timing.
So how do you determine in your mind when things are going against you?
Honestly, it's price. If the price is going down, you're wrong. The ultimate arbiter is the market. Yeah. And we will talk about this at length, presumably in another episode, but previously in 2018, I was very long oil companies, I had BP and Shell, and small oil companies, and I knew it was time to get out, and I thought about just squeezing that last 5% out. Mm-hmm. And essentially, by waiting a few weeks too long, I lost, I'd say, 90% of the profits of the trade because it went against me. Yeah. And then I liquidated the entire portfolio into a falling market. The prices went against me. And what should have been a very profitable trade ended up being a minimally profitable trade.
Because one of the ways of managing that is to come out in chunks, isn't it?
It is. But this is the thing, it's a learning process. And actually, I, in this year, read a fantastic book called Thinking in Bets by Annie Duke, which made me really reappraise how I deal with portfolio. And I hope that faced with the same dilemma again, I would take half the money off the table. And if I'd taken half the money off the table, I'd be much happier with the subsequent return performance.
Yeah. I think one of the problems of being a private investor is that whilst you have a great deal of flexibility in terms of what you invest in, what your time frame is, there is no external pressure on you for making money. Obviously there's an internal pressure, but that very flexibility is also a disadvantage in the sense that it gives you so many options all the time.
I think that's right. I think that the biggest problem is that there's so much information, and trying to determine what the options are out of the thousands and thousands of stocks and bonds available.
Absolutely. So I was reading Money Week, and every week they recommend various ETFs, investment trusts and shares. But if you go through and add up all of the investment recommendations each week, there may be 10. They include a review of the tips in newspaper services and so forth. If you include those, there may be 10 or 12 companies recommended investment trust every week. Well, multiply that by 52, and you get 600 tips a year, and that is just chaos. Mm-hmm. You can't actually invest on the basis of following ideas that you read about without having some underlying theme on which you base. So it may identify companies for you in the sector you're interested in, but you can't simply follow those tips at random without understanding the basis.
Absolutely. And I would say the vast majority of those tips are absolutely worthless, and you should avoid following them. And on that note, Richard, let me talk about how I attempt to identify opportunities. So, as a private investor, your disadvantages are that you have no information advantage compared to institutional investors.
And in fact, they have access to vastly more information.
Precisely. So, you have very limited information. You have no analytical advantage in that they've got vast computers and analysts, etc. What you do have is total control over your portfolio. You know your risk appetite, as Richard said, and you are under no performance pressure apart from your wife. So that means you can take your time, and you don't have to choose fashionable stocks. You don't have to follow everyone else, and that is an advantage.
Yeah.
So, the way I think about investing is essentially what you're trying to do is trying to predict what's going to go up over the next couple of years.
And in order to predict, you need information, but you need better information or a better system of analysis than is used by most market participants.
That's right. And so what we've talked about before is that you have no information advantage on individual stocks. So the way I do most of my investing is I think about cycles. And there are certain cycles which I think are predictable. And by following those, essentially you don't have to predict, how each individual stock is going to do and the vagaries of each individual stock, because you know that if the cycle turns, then they will benefit. So, for example, oil companies like BP, if the oil price turns up, then you know this BP share price is going to turn up. You don't really have to dig into, which oil wells BP is drilling everywhere around the world. So I follow the inflation cycle, business cycle, interest rate cycles, and you will see in the podcast we have dials which we'll be reviewing every week or month, which will help you and us appreciate where we are in the cycle.
And those cycles then give you an indication as to which sectors you want to be moving into and which you want to be moving out of.
Exactly.
Give you a feel for what the timing might be. And then with that information to hand, you can then start doing some research into the sectors and which companies particularly you want to invest in.
Precisely, that's right. Now the flip side of that is that there are secular trends which you expect to continue for a long period of time, and you invest in companies now which you expect to benefit from the continuation of that trend. So, for example, the move into clean energy and electric vehicles. Mm-hmm. If you think about the supply chain like hydrogen or lithium for the batteries, you can think about buying into companies, say, the lithium sector, expecting the demand for lithium batteries will drive the price of lithium up. And as long as that trend continues, the price of lithium should continue to rise.
And that runs through the business cycle. And
precisely.
And whilst it may fluctuate, in accordance with the business cycle, the trend remains upwards, with some caveats, in particular with the clean energy, new technologies. You can never be quite certain what technology is going to take over where, which one is going to lead, which group are going to lead, and also at what point a technology may move from being the leading technology to an obsolete technology.
Absolutely.
And one always has to be mindful, I think, of Betamax, the video.
Yeah, no, absolutely, but also like BlackBerry.
Yes, yeah, absolutely.
Where you have, or Nokia, where you have very highly rated companies, and actually they can disappear incredibly quickly. Yeah. And things like lithium, yes, the demand for lithium will increase, but actually there'll be lots of mines.
And supply will also increase. Yeah.
So what I don't do is I don't do deep analysis of individual stocks. I don't look for deep value. And frankly, where I have completely fallen a cropper is buying stocks just for their dividend yield without really knowing too much about them. And that has been invariably a big losing strategy.
Yeah. So how do you go about identifying where we are on the cycle, Keith, in these cycles?
So if we look at the first chart, so clock here, which is the business cycle, we try and identify where we are in the cycle. So obviously at the bottom of the cycle, the economy is doing badly and company profits are low and generally share prices are low. And that is the peak time to buy. So you then want to hold the shares through the expansion, which could be years and years and years. Mm-hmm. And then when you feel that the business cycle is peaking, and although we've attempted to get rid of the business cycle since time immemorial, it continues, then you want to sell. And so last year, one of the reasons I've been lucky this year is that I sold all my equities in 2019 because I thought the global expansion was very long in the tooth. So I was 100% in bonds and cash coming into this year.
Right.
So that's exactly, me playing the cycle.
Yeah.
So I got very lucky with COVID.
Fortuitous with COVID, yeah.
Okay, so that's an example of one of the cycles, and we obviously look at the oil cycle, the interest rate cycle, and the most important one is the inflation cycle, which is multi-decade, and we're at a very interesting moment here because the inflation cycle, after 4 decades of declining inflation, may be on the cusp of turning, and that will be an ongoing discussion, because I know you, Richard, think we are definitely turning up towards inflation.
Well, I think we may well be, but I think that there are a lot of valid counter-arguments as well, and I think that the situation is extremely complicated with COVID. So, for example, we've got the demand destruction, but we also have supply destruction.
I completely agree.
And trying to work out where the inflation dial will settle with that, and also quite possible a huge recessionary impulse from COVID.
And I think we will have an in-depth discussion of this in the review of the year, because it's not something we can cover in 2 minutes.
So one of the things I wanted to talk about, Keith, was the process that I've gone through in terms of managing my investments. You talk about how you go about selecting the sector and selecting the stocks within that sector. One of the elements of investing I find very difficult is actually managing the process of buying, holding and selling to maximise the return on my investment. So I have tried short-term trading and I can't do it.
No, neither can I.
It doesn't work for me. I don't know why I'm buying a share. If it's a short-term trade, you're looking for a few percentage points up. If it goes a few percentage points down, what do you do with it? Your thesis is completely negated. But
I'd also say, Richard, that the costs of trading are really very high, and your information advantage, if you are constantly paying 0.5% in stamp duty plus the spread, you have to be extraordinarily good just to earn your money back.
It's absolutely negligible. So in the way I think about the world, I think in quite a long-term way. I try to understand what is happening in the world and how that might affect the economy and businesses, and which is very similar to your analysis of the business cycle, I guess, in concept, although the way I think about it is a bit different. And that then enables me to identify which sectors I think I should invest in. But because I'm thinking about a very slowly developing macroeconomic process, it of necessity means that my investments, the timescale in which I expect those investments to work, needs to match the timescale of my thought process, which is months and more likely years. So I'm thinking that is a natural, comfortable timescale for my investments. If I then try and trade on a weekly or monthly basis, it messes with the way I think. I'm not applying the information that I have worked through, and I don't receive the benefit of my investment.
I completely agree with that, but I think that's only possible if you have your position size right.
Yes.
So if you are 100% convinced that BP is going to be 5 times the value it is now, and you put 100% of your money in BP, if it drops 30% in the meantime, you are going to be in a lot of pain, and you're going to be inclined to cut some of it.
Absolutely.
So having a diversified portfolio, so that if one stock goes down 30%, it doesn't really matter, I think
that's absolutely
crucial.
right. I also think that with cycles, you can usually identify more than one sector. If you're looking at the long term, you don't know quite when each sector is going to demonstrate its maximum return, but they probably won't coincide, and you will have where the timing of one sector isn't quite right. You may find that another area of investment is doing well, And so the troughs hopefully can be slightly balanced by peaks in another area.
Well, I think hopefully that's true, but the reality is that a lot of these cycles are quite synchronous. So the copper cycle, mining cycle, and the oil cycle, they may differ slightly depending on Chinese stimulus, but they are quite coincident. So just to go back over my portfolio, one of the consequences of this discussion is that you will see no secular defensive companies in my portfolio. So there's no Tesco, there's no British Aerospace, because I don't think I've got any information on those companies. No advantage. Will they go up? Will they go down? I think, frankly, I don't think I have any advantage over everyone else in the market in analysing them. I think they have an advantage over me, so I don't bother.
Yeah.
Now, one of the things that you brought up, Richard, is the psychology of investing, which I think is really interesting. Well, do you want to explain what you meant by that?
Well, yes, I've alluded to it a little bit. It's simply that if you have a thesis that you believe is going to play out over a number of years, which is the way I like to think about things, then if you're going to invest, you have to invest on the same basis. And if you invest on a timescale that's different, you simply have a conflict between the way you're thinking about your investments and the way you're thinking about the world.
Yeah.
And that conflict will manifest itself in a poor investment performance, because you will either buy the wrong shares for the wrong reason, because you won't be applying your thought process, or you will buy the right shares and you will sell them too quickly.
Okay, because I also think about my own psychology when investing, but in a slightly different way, in that I'm very aware of my own biases. So, in particular, one of the things I do is that if I decide to buy a stock, I try and buy it right now. Because if I'm really keen on it, I know that there's a negative selection bias in price movements. If it goes up, I think, oh no, it's going against me, I'd better pile in.
Yes.
And I will tend to pay more for it and if it goes against me, I'll think, oh, it's getting better value, I'll hold on, and then it will, runs away from me. So it's better just to do it. Yeah. And in particular, when I'm selling, I just sell. Just get out right now.
Yeah. Interesting.
So, Richard, in the last section, we were talking about the process by which we buy stocks. So the next question is, how do you sell them?
Well, that's a very good question, Keith. Usually out of panic. But I think one of the widely acknowledged difficulties of investing is, when do you exit an investment? And I would say that there are two reasons to exit that I think are important. One is sometimes you should take some profits on the way up, so you have some funds available for reinvesting. Sure. But the caveat there is that if you don't allow your winners to run, then you're not maximising the return on your portfolio.
Absolutely.
And I like to use a very simple example. If you have £30,000 to invest and you buy 3 companies, one of them goes up 5-fold, one of them stays the same, and one of them goes to 0. Your total, and then you close your positions, you have £60,000 for your £30,000 investment.
Yeah.
So you've got 100% gain. If you sell the one that went up 5 times when it doubled, you would have a £40,000 gain for your £30,000 investment, so you would have a 30% profit instead of 100% profit.
Yeah.
And that all came about by selling your one winning share too soon.
Yeah. So I think selling is something everyone struggles with. And if nobody struggled with it, you wouldn't have a market, basically. Everyone would be selling it, your prices wouldn't go up or down, basically. You have to have a buyer and a seller at every price in the market. So when I look at my portfolio, I'm trying to work out where we are in the cycle generally. So for me, there are 2 reasons to sell. Either there's something going wrong with this company itself,
Yep.
or the cycle. I think the cycle is peaking or turned. Now, hopefully, I'm trying to make big decisions about the portfolio. And this year in particular, I largely got that right. So I started off the year in cash and bonds, and we'll talk about it in the annual review. And then when you look at my asset allocation, suddenly in March I went from 100% cash and bonds to 100% equities and gold. So that's one reason to sell. The other, which I struggle with, is if there's something going wrong with the company, and the advice is then always to cut your losses.
One of the difficulties is that the price is a reflection of what other investors think, isn't it? So if other investors are exiting for some reason, that isn't actually a reason that relates to the profitability of the company and the success of the investment, you don't want to follow them. And I remember reading a book, it was quite a complicated book actually, and I can't remember the title of it. I'll look it up. And one of the key messages that I took away from that is the majority of people who sell a share are short-term holders.
Yes.
And you don't want to be following the short-term holders if you're a long-term holder, which we are.
We are.
So you have to be careful that you are not reacting to the behaviour of people whose investment strategy isn't yours.
Well, one of the things actually just doing this podcast has made me realise is that last year when I decided to get out of stocks altogether, I just cut the entire portfolio. I sold absolutely everything. And I didn't discriminate between cyclical stocks and secular stocks. So my investments in clean energy stocks, I sold, and as we've discussed, when I went back to buy them now, they are 4 times the price of when I sold them. And because that trend has continued, I should have just kept on through.
But had you held them during March, you would probably have found that they were 50% down on your purchase price.
That's probably true.
And you may have exited them because of uncertainty.
Yeah.
So I think March was a particularly difficult time for any investment decision. However, I mean, I'm with you. I had shares in Jubilee Platinum, which doubled, and I sold them. And I was looking at them yesterday, and they are 4 times what I sold them at.
Well, I think we should actually do a separate. Are you going to do my worst trade on Jubilee Platinum?
Yeah.
Because I think you should, because I also held Jubilee Platinum, and I made exactly the same mistake, except I probably sold it a bit earlier. And I think it's interesting you think that's a huge mistake, because actually I don't really.
Yeah.
Okay, so go on. Well, I thought we would move on, unless you have any.
No, I'm happy to move on.
Okay, so actually, one thing I would like to do before we move on to discussing what you can expect on a weekly basis from the podcast is just briefly show you my P&L since I started managing my SIP in 2011. So prior to that, it was I was opted into the. It was managed by Fidelity, and then I opted out and took over managing it myself. And you'll see in the early years, I really actually didn't manage it actively at all. I didn't really pay much attention. And since I have taken more interest, I have done okay. Although, actually, if you look at the portfolio closely, there have been various cycles which I have played both well and badly, in that I've largely been playing the oil cycle, and I generally got the upswing, but then failed to get out, and also captured the downswing, which is not quite ideal.
Hence the importance of knowing when to sell.
Yes, precisely. And actually, you'll see a lot of the outperformance has actually been this year. So last year, I just didn't like the way the market was. I thought we were far too high, overstretched, very long in the tooth. 10 years into the business cycle, and I knew a downturn was coming, I didn't know when. And COVID has been, in some way, been very lucky for me.
But I have to say, Keith, typically you've done very well, but also typically in investment, a lot of outperformance comes in a very short space of time.
Yeah.
And then nothing happens for a long time.
So the other thing I wanted to show actually was my turnover. So you were talking earlier about how you don't trade that much, and actually when I look at the statistics, and they are biased by the fact I've basically traded almost nothing for the first 3 years of since I managed it.
Yeah.
But you'll see that actually there are whole periods where nothing happens, and then there are periods where I either do a lot of buying or I do a lot of selling.
Yeah, very interesting. And we seem to be entering a period, if the trend will continue, Keith, entering a period where you're going to be doing very little.
I certainly hope that is true, Richard. And we talk about this in the outlook for 2021.
Absolutely. Yeah.
Where hopefully equities, I think, are on an upswing and the business cycle is on an upswing.
Yeah.
So the next section is what we will be talking about and what you can expect on a weekly basis. So Richard, what can they expect?
Well, Keith, we are going to have a weekly portfolio performance and review of trades. That is, we will say what we have or haven't done.
Oh dear.
And yes, hopefully it'll either be good news or no news.
Yes.
Although there may be some bad news in amongst it. We will be honest.
Absolutely.
And I think one of the difficulties for private investors is they often work alone, and people only ever declare what's gone well.
Yes.
And so you get this rather skewed sort of sense of where you lie on the distribution of success. And I suspect that it's useful to see other people talk about what's gone wrong.
Yeah.
And we're going to do a weekly review, aren't we, Keith?
Yes, so one of the things I do is that I have a checklist so I write down what the levels are of various things every week. And I think one of the problems I have as an investor is that you look at the portfolio every day or every week, but actually you don't think about it. Mm-hmm. You just skim over it, the top, you have 30 stocks, and you just kind of briefly look down, and as long as nothing's going on, you don't really think about it. Whereas actually, by forcing myself to write down the levels of various things, it forces me to think about them and to assess whether anything's changed and I need to do anything. So each week we'll be running through the checklist first.
Good. And then I think you also do a monthly review, don't you?
Well, the cycle watch. I mean, the cycles are obviously very important to the way I look at the market, but the reality is they don't change every week. We're talking about cycles. In the case of the inflation cycle, we're talking something that changes over decades, and so we don't need to do it every week. We'll do it every month.
Every monthly. And then we thought that we would do an investment topic of the week.
Yep. So, for example, the inflation-deflation argument would be example, or the outlook for uranium, which we were talking about recently. Something like that, and we would be, if anyone wants to write in with suggestions, we will cover them.
Yeah, absolutely. And so we'll just try and pick something that is reasonably topical and of interest, of general interest.
And then we will have a small segment called the 2-minute pitch, where one of us will try and pitch an investment idea, a stock or something else, to the other who will try and pick holes in it.
It'll be, would you like to buy my worst trade?
Yes, exactly. Well, So, I mean, given we spend quite a lot of the time throwing ideas back and forth, we'll see what we can come up with.
And speaking of worst trades, we're going to have a worst trade section.
Yes. So, I hope that we will get listeners to phone in and share their worst experiences, because we will also be sharing ours. And I personally think that you learn a lot more from analysing your disasters than for your successes. Because in the case of successes, it's gone right. There's not really much to talk about. Whereas actually when you look at where you've lost money, it forces you, the pain forces you to examine what you could have done better. And so in the review of 2020, I will be going through one of my disasters of the year, and as we go through the various weeks, other disasters, and there have been many over the years, will be covered.
Absolutely, plenty to choose from, Keith. And of course, we learn from our mistakes. We don't learn from doing things well.
Yes.
And if we have a success at investment, we consider ourselves to be clever.
Yes.
If we have a failure, we consider ourselves to be unlucky. In reality, it's probably the reverse. If we have a success, we're lucky. And if we fail, it's a true reflection of our abilities. And then we're going to do other things on an ad hoc basis, aren't we?
Yeah, absolutely.
Book reviews, maybe, or
Well,
other ideas.
Absolutely. I think hopefully we'll have a website where we will have a section talking about recommending books we've enjoyed, and actually we both read quite a lot about investment, and we will dip into books we have enjoyed and think are important.
Definitely. Good.
Okay.
I think that covers it, doesn't it, Keith?
So I hope you will join us on this journey.
Absolutely. Look forward.
So before we go, can we please ask you to press the like button on YouTube and subscribe to the channel? That helps us find a wider audience.
And if you have any questions, comments, or you would like to share your worst trade with us, please email us at info@portfoliomatters.co.uk.
Thank you for listening, and we hope you'll join us again next week. So it's goodbye from Richard Wheaton.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.